What is going on, my friends? It is so good to be here with you today. My name is Ryan Williams, back with another one, and today's video is super special. Recently, my little brother, who also dabbles a little bit in the stock market, came to me saying that he wanted to start taking it more seriously and be more active with his investments. Now, like me, he also has a portfolio with Charles Schwab, but he pretty much just invests his Christmas money, his birthday money, stuff like that, you know, not super consistently. But he told me he is ready to change that. He is wanting to start actively investing for his future, and he came to me to, figure out what might be the best place to start. Truthfully, guys, I was honored that he came to me, and as his brother, I'm also very proud. I know the difference that investing his stocks is making for me, and I'm excited to see him starting to get excited about it. So he shared with me his entire stock portfolio. I got to see all of his holdings, all of his positions, and then from there I made some notes and kind of thought about some tweaks that I would make if it were my portfolio to get started on the right foot. I essentially offered him an idea of what an entire portfolio transformation might look like, and I've got to tell you guys, it's pretty sweet. So what I'm about to show you guys is the conversation I had with my little brother when I walked him through all of these proposed tweaks. What you're about to see is essentially his portfolio before and after. You'll get to see all of his holdings, the performance of his portfolio, which is actually pretty impressive, and the difference that some of my ideas might make for his portfolio if he were to make these tweaks. And real quick, if you guys are stoked to see this portfolio transformation, please give this video a big fat thumbs up, okay? It would mean the world to me. All right, thank you guys so much for doing that. And now, without further ado, let's get into it. The first thing that I was kind of looking for is how to maybe capitalize on some of the great profits you've already had. And we'll go through your portfolio here in just a minute, and I'll explain a little bit more of that. Number two, how can we reinvest some of the money that's allocated in your portfolio into some more reputable, recognizable companies that might be better long-term hold on to for the long term. Right. Number three, how to create more diversification in your portfolio. This is a big thing I'll touch on as we go throughout, and I'll show you something really cool that'll help paint a better picture as to what I'm talking about. And last but not least, increase your dividend income for your portfolio. That's a big one for me, and so I had to throw that in there and see how we can increase your basically the money coming in from dividends. Does that kind of make sense? I know I was tripping over my words for a minute. Okay, cool. So now what's that?
So it totally makes sense.
Okay. So now what I'm going to do is I'm going to share my screen real quick.
Okay.
And what we will be looking at here, can you see that?
Mm-hmm.
Okay, great. So what we are looking at right here, this is a dividend portfolio tracking spreadsheet that I've made. This is what I use to track my portfolio. And it shows a ton of cool metrics. I'll just briefly go through it. So obviously over here, these are the different stocks that you have right now. They're ticker symbols, basically the shorthand for looking them up. Obviously company name. This is how many shares you have. This is your average cost per share. And then as we scroll over to the right here, these are just some other metrics like how it performed today. So it looks like today you're down about $80. Your total change overall. So how much your portfolio has grown overall, which looks like it's actually doing really good, $3,100. Your portfolio is up almost 50%, which is incredible. That's really good.
Sweet.
Yeah, so good job there. I know you put a lot of hard work into it.
Yeah, that's first thing I think about when I wake up, last thing I think about when I go to sleep.
Yeah, right. I bet. And so moving on here, these are just how your portfolio is diversified by industry. So what sector some of these stocks are in here, it lists them all here. And then also, there's some other stuff in here. We won't really cover PE ratios or EPS, earnings per share. This portfolio allocation ties into the diversification of your portfolio, which, like I said, is something we'll touch on more as we go through this. And then some of these big ones over here, dividend yield. This is the percent dividend yield of your total portfolio right here. And this is by individual stock. Don't worry about this too much. I can explain it a little bit more as we go on. The important thing to remember from this column right here is this number right here. So right now your portfolio as it stands has a 0.86% dividend yield. And essentially what that means is per your market value right here. So this is the total value of your portfolio. I think when you sent me the video recording to see your portfolio, you had like 800 bucks sitting in cash. So really in your portfolio, you've got maybe about $10,400, $10,500 total, somewhere in there. And that's not counted right here. So for all the stocks that you own, you've got about 9,800 bucks, and 0.86% of that is paid to you in dividends, which is this number right here, your annual cash flow or your annual dividend income right here. So this is right now how much you're making right now every single year just from dividends, from not doing anything, just being paid out that cash flow. Does that kind of make sense so far?
Mm-hmm.
Okay. So the very first thing that I did when looking at this is, what are some stocks that might be good to get rid of? What might you not need, or what could be better replaced with other stocks? And so I'm actually going to look at this document right here. So this is something I made, just kind of listing out what I would, if it was me, what I would maybe consider selling or getting out of. So first is Alto, which is this right here, Alto Ingredients, which I found out is based here in Sacramento, which is pretty cool.
Wow.
Yeah. So, I'd maybe sell out of that. And if you sold that, you might get about 57 bucks out of it. You've done pretty well with Delta Airlines. So your Delta Airlines so far is up, what, right here, 16%. That's pretty solid. You don't have a super big position in Delta, which is why I'm thinking, oh, you could probably sell out of that and reinvest into a better company. And if you did that, you'd get maybe about 150 bucks. DRE, which is Duke Realty, which actually isn't a bad stock, pays about a 2% dividend. It's what's called a REIT, a real estate investment trust. So it's a company that invests in different real estate assets, and then you get paid a dividend from that. So if you were to sell out of that, which, I'd probably recommend, you'd get about $550. That one's actually performed pretty well for you as well. Up 122%, which is pretty insane. So you basically doubled your investment on this one stock.
It's crazy.
And this kind of ties back to one of the first things I was saying, is some of these stocks, you can capitalize on these profits. You might want to lock in some of these well, not so much this. You might want to lock in that 122% gain. You might want to lock in this 93% gain from Golden Valley. But anyway, nonetheless, I won't go through each individual thing, but in general, this is kind of what I would recommend consider selling out of. And when you see like 1/2 of Ford, that essentially means, so right now you've got 100 total shares of Ford. I might recommend selling about 50 shares.
Gotcha.
Hold on to some of it. Ford's a good company, but you don't need that much in your portfolio as it currently sits. And the reason for that is, if we go over here to this portfolio allocation, we can see that just Ford alone makes up 13% of your total portfolio. Similarly, we can see that Tejon Ranch, TRC, makes up almost 20% of your total portfolio. So let's say, God forbid, something happens to both these stocks, or they do just terribly. That's over 30% of your portfolio that's affected by that. Same thing with Berkshire Hathaway, but that's a different story, and I will get to that a little bit later.
Okay.
So anyway, by making these changes, you would have, selling out of these stocks, all of Alto, all of Delta, half Ford, all the way down the list, you would probably have about $43.56 in cash to reinvest into other stocks. It might be a little more, it might be a little bit less. Also, I actually do want to touch on these last three right here. So these are all ETFs right here. And the reason I kind of want to explain this one. I would sell out of these is because you just don't need that many ETFs in your portfolio. You can do a little better. I would keep this one though. This one's, at least for now, I would keep this one. And so before I get to the buys, I want to stick to these sells. So what I would sell is all of this. Well, here, let me do this. All of this, oops, all of this guy, all of that guy, all of that guy, maybe half of that. I'd get out of this guy. I'd get out of that guy. This one, I'd sell half. Like Tejon Ranch, like Duke Realty, is a REIT, a real estate investment trust, but they don't pay a dividend. However, you've built up a really good position with Tejon Ranch. You have over 100 shares. That's a lot. And
Yeah.
so, you might not want to sell out of, I don't want that. You don't want to sell that. You might not want to sell out of all of them. You might want to hold on to half of them. Just see what happens. Don't completely get rid of it. Same thing with Ford here. Don't completely get rid of it, but you don't need as much as you have. I'd also sell out a Workhorse, maybe sell out of these 3 REITs right here, or ETFs right there. And then just keep this guy, keep SCHD, just keep that how you have it. Maybe sell out a half of Ford. And then I would hold on to all of Berkshire Hathaway, which is, I'll just explain it right now. The reason I wouldn't sell any Berkshire Hathaway is, number one, it's a legendary company. My issue with Berkshire Hathaway is that it doesn't pay a dividend. However, by buying into Berkshire Hathaway, which is what's called a holding company or management company, by investing into this one stock right here, similar to ETFs, you'll be investing in companies like Coca-Cola, like Apple, like Verizon, and a ton of other recognizable names. And this is probably one of your best performing stocks. I mean, you've gained almost $1,300 just in this one stock. And because of how this company is set up, it's likely that it'll continue to increase in share price over the years. And if you decide to sell out of it later and put it into other dividend stocks, that's great. Same thing with Ford. Same thing with this ETF right here. There might be another dividend paying ETF or stock you might want to reinvest in. But for now, just let them do their thing. I wouldn't necessarily touch them right now. I think just making all these changes will be enough for now. And then you can adjust as you go from there. But this is a great place to start. And so does this all kind of make sense so far? I know I'm kind of rambling through this a little bit.
Yeah, it makes sense. It almost looks like I'm pretty much just going to get rid of half of my stocks, meaning just sell out of them.
Yeah.
Because there's other things out there that I could invest my money into that'd be a smarter buy than to keep these things right now.
Yeah. And I think as we go on, as we continue on in this, the reason will make sense. Once you see how it's going to affect your portfolio by making these changes, I think you'll start to get an idea of why.
Okay.
And just let me say this right now, like nothing wrong with any of these companies, nothing wrong with, well, Workhorse is kind of a speculative one. Well, that one's kind of TBD, but nothing's really wrong with Hawaiian Electric. Nothing wrong with Delta Airlines. It's going to be around. I don't know enough about Alto Ingredients, but you don't have a huge position in it anyway.
Yeah.
Nothing wrong with Duke Realty per se, but there might be other things that you could better invest in, and invest your money into and get a better return and also get a better dividend yield. So, excuse me, that brings me to the buys. So by making these changes, like I said, you'll have about 43 and a half, well, $4,350 or so to play with, maybe a little more, maybe a little bit less, but you'll have a good chunk of change that you can then go and reinvest in what I think, all these stocks right here, which I think may be a little bit better buys. This one right here is Procter. I'll briefly explain what these are. This one right here, this first one is Procter & Gamble. Procter & Gamble, they make household goods. They make things like Crest toothpaste, a ton of dental stuff. I think they do also like toilet paper, a ton of household goods. I could pull up a list for you if you want, or you can just Google Procter & Gamble companies, whatever. A ton of stuff that you'll recognize, you'll have heard of, and it's a ton of stuff that people are always going to be buying, that people always need. They're what are called consumer staples. People always need toothpaste. People always need paper towels, toilet paper, that kind of stuff. This one pays a pretty solid dividend. It's been paying a growing dividend for the last 65 years. So it's a relatively secure company to buy into. So you're going to get some good cash flow that grows every year from buying into this company. The second one right here, ticker symbol MO, this is Altria Group. What Altria Group does, they manufacture cigarettes and vapes and stuff like that. And for obvious reasons, I mean, this stuff's just always going to be around. People, for better, for worse, are hooked on this stuff. And so they're going to keep buying it. And this company pays a really good dividend. Like Procter & Gamble, it's been paying a dividend for a long time. Now, where Procter & Gamble has like a 2-point-something% dividend yield, Altria Group is up in the 7s, I believe, or maybe even in the 8s. So it's like pays 4 times the dividend that this company does. And, it pays it's what is referred to as a dividend king. It's probably one of the better paying dividend companies out there. Next up, you know this company, don't need to explain it, AT&T. And one reason to buy AT&T is because just like Altria Group, it pays a solid dividend. AT&T is up in like the 7%. And just to give you a general rule of thumb, anything maybe above like 3% or so dividend yield is considered like pretty solid. So paying a 7% dividend yield, paying an 8% dividend yield is pretty exciting, at least to people who are into this stuff. Okay, next, Starbucks. I don't need to explain it. Starbucks, great company. It's going to be around a long time. And Starbucks pays a really high, not a high dividend, but its dividend grows very quickly year over year. And also the share price of these stocks go up and up and up. And so you'd get some good capital appreciation from owning this stock, which means the shares that you own will increase in value.
Got it.
Same thing with Apple here. Doesn't pay a very high dividend, but it's a great company. It's a pretty safe investment, obviously. And it's going to appreciate year over year over year. So going back to this for a moment right here, the percent that your portfolio has grown is over 45%. By continuing to buy into some of these better growing companies like Starbucks and Apple, it will help that the percentage of your portfolio continue to grow in value, not just from dividend yield, but by capital appreciation. So it's important to have both. Next up is 3M. 3M is another company that makes not really household goods, but industrial goods. 3M manufactures like Scotch tape. They do command strips, command strips. Yeah. They do stuff like that. Masks, you've heard of them. I mean, obviously, the masks. They manufacture those. Ton of stuff like that that's used in industrial work, construction, stuff like that. Another great dividend paying company has been paying a dividend for the last 60 something years. So it's the dividend's very safe, which is why one might buy into it. It does appreciate as well. I think my 3M's up over like 20%, and I've owned it less than a year. Gosh, I could be wrong on that, but it's grown quite a bit. Next up is Johnson & Johnson, healthcare company. They make Band-Aids. Hydrogen peroxide.
So
they're obviously doing the vaccine. I think they make some other medicines. They might have Tylenol. I could have that wrong, but I think they have Tylenol. But they have stuff that you've heard of. So another one that people are going to be buying into for a long time, like 3M, like Procter & Gamble, like Altria Group, has paid a dividend for a long time. And then this last one right here is Chevron. Obviously, it's a gas company, energy company. Chevron pays like a 6% dividend. Pretty solid. It's not going anywhere. So those are the buys that I would recommend. And so with that said, let me go over to the after. I have this spreadsheet for the after these changes, what that might look like, selling out of the companies that I've proposed here and then reallocating them into the companies we just talked about. And this is kind of what it would look like. As you can see, some of these stocks have changed. Some of them are still the same. Same Berkshire Hathaway. Ford cut that in half. Instead of 100 shares, there's 50 shares. And then what's left here? Tejon Ranch, same thing. You had 114, but according to this, you have 57. So just a few tweaks. And as we can see what that does here, so your total change overall right now is about 3,100. By making these changes, you don't lose out too much on that. Your gain is still about $2,100. And this difference here, you're not losing any of these gains. What you're doing by making these changes is realizing the growth that your stocks have appreciated by, if that makes sense. And so it takes your total overall growth from 46 to 20, almost 25%. And that's not necessarily a bad thing. I think some people would like to see this higher number, but it just means that you've realized some of the gains that your stocks have made and turned those into actual cash. Hopefully that makes sense.
Yeah, it makes sense.
Do you have any questions so far? I know this is a
lot. No, not really. No, it's pretty straightforward. And it looks like I'd only keep, like I said, like maybe like even half, if that, of the stocks I have. And then everything else is invested into these other ones that are, probably going to be around for longer, to be honest, and be relevant for a longer period of time. And that's really what it is.
For sure.
Yeah.
And the ones, in the before here, as your portfolio currently is, the ones that you're selling out of, they're not ones that you have a lot of, like a super big amount of you don't have a super big position in them anyway. So you've got a huge position in 4 that's done really well. So you don't necessarily want to get rid of all that. You worked hard to build this position. Same thing with Tejon Ranch. You worked hard to buy all of those shares. And same thing with Berkshire Hathaway. You've had that for a long time, and you might not necessarily be ready to let go of that yet. And it might not make sense to. But some of these other ones like Workhorse or Hawaiian Electric or Golden Valley, it's, you know, you're going to be better off investing into something like, in the long term, something like Starbucks than Golden Valley.
Yeah.
You can rest assured knowing that Starbucks is going to be probably around a lot longer, or at least a lot more relevant for a longer period of time than some of these others might be. That's just an example. So moving on here, let's see, moving on. Okay, this is where it starts to get exciting. So before, as your portfolio currently is, remember you have a 0.86% dividend yield, less than 1%. And remember what we were kind of saying is like maybe above 3 is considered like rock solid, like really good. 2's not bad. 2's a great place to be. 3's pretty solid. 4 is great. So somewhere between 2 and 4 is kind of, well, 2 and above really is where you want to be. So right here could be doing a little better, but after these changes, your new dividend yield would be 2%. So by making these changes, you'll have basically 2.5x your dividend yield. And so what that will look like just in terms of money, your annual dividend income will go from almost $85 to about $210.
Oh, wow.
So quite a bit more. And this is just in year 1. Remember, these things grow over time, which is something I'll touch on too as we keep going. But that's kind of what this would look like as far as the dividend yield. Now, there's one other thing that I haven't showed you for this portfolio, and that's your diversification. So this is the before your portfolio right now. Let's go over to this tab right here. This is the diversification. So this pie chart, or these pie charts, show how your portfolio is allocated by sector, and over here it's by stock. So as you can see, just by looking at it, you've got some big slices here, a lot in ETFs, a lot in financials, a lot in real estate, and a good amount in automotive. And then similarly, we can go over here and we can see that there's some stocks that greatly overpower your portfolio. They take a huge percentage of it. And the reason why this might not be the best thing is because of what we said earlier. Let's say for some reason, something happened to Ford, something happened to Tejon Ranch. Well, this huge chunk and this huge chunk just really takes a hit. And as you can see, that's a pretty big, that's almost a majority of your portfolio. Not a majority, but it's a good chunk of your portfolio. And so doing the same thing, going to this diversification tab for after these changes, it looks a little bit different. So before and after, we can see that everything's just a little bit more balanced. You know?
Yeah, you're right. I mean, other than really probably Berkshire Hathaway.
Yes, other than Berkshire Hathaway. Other than Berkshire Hathaway. But like I said, the good thing about Berkshire Hathaway is it in itself is pretty diverse. So inside of Berkshire Hathaway is a ton of other companies. You've got Apple, you've got Coca-Cola, you've got Verizon, you've got T-Mobile, you've got all these other companies. So it's almost like an ETF in itself. So it's pretty well diversified. So this Berkshire Hathaway would be a little bit more secure than just buying AT&T or just buying Starbucks, if that makes sense. And if we go over here by stock, diversification by stock, we can see the same thing. It's just a little bit more balanced. And the crazy thing too, is if we compare the number of stocks here between these changes, before right now, you've got 13 different stocks. After these changes, you've got one less, you have 12, you'll have 12, which is crazy because the way it's diversified, it almost looks like you have more stocks after these changes, but really you have one less. And that's going to be good for you for a couple of reasons. Number one, it's going to allow you to build out bigger positions in the stocks that you have because you don't have as many stocks to worry about. So you can invest more into less stocks. Gotcha. And also you're not investing, you won't be investing a ton of money. So it's going to be easier for you to choose where to put that money or choose where to invest. Overall, it's going to allow you to build bigger positions in the companies that you have.
Got it.
While having more cash flow, more dividend income, and also while having stocks that are probably going to be more secure, more safe. They're ones that you won't have to worry as much about. These are all companies, for the most part, all companies that you've heard of.
Yeah.
So, and that's pretty much the changes that I've made. Does that make sense?
Yeah, totally.
Okay. Any questions on anything here?
No, I mean, it makes sense to me, and I'm kind of excited about it now.
Okay, good. Were you not so much before?
Well, I'm not saying I wasn't beforehand. I'm just saying now these are things I could see being relevant and things that I'm actually like aware of. Whereas beforehand, it's like I know about it, but I'm not technically like invested into it. No pun intended.
Right. No, I get you.
So, but yeah, this is good. This looks, and it looks better too. So, and I think for the grand scheme of things, and in terms of longevity, that this is probably a better move to invest into these right here. So,
yeah, and if you're just getting into it, I mean, when you came to me, you said you want to start regularly putting money into it, which is great. That's awesome that you're making that step. And just for those of you who don't know, Kale's only 24 years old, so he's got a lot of time to invest. And so it's good that you're taking it seriously now. I know you've been doing it for a while, but taking it seriously now, or trying to be more active with it. And by, investing in companies that it's going to make it all the more easy. It's going to be more exciting to invest in Starbucks than Golden Valley Bank. Same thing with Apple or.
And if there's any Golden Valley Bank people out there, it's not a, no offense.
Yeah.
Not you, it's us.
Yeah. You good tellers, but no dividend.
Yeah. I mean, come on. Maybe if you had a dividend.
If you had a dividend, we'd be a little more excited about you, but you don't. Anyway. So the next thing I want to do is I kind of want to show you over time how this portfolio might perform. So what I've done, this might be something I've showed you before, maybe not, but this is a dividend calculator. So essentially what I've done is input the stats of your portfolio after these proposed changes. And we're going to see how it performs or will perform over time. So starting principal, starting amount, I'm going to say about $10,000 in your portfolio. Mm-hmm. We saw that your dividend yield would be about 2%. I think you mentioned to me, maybe you're going to invest like $100 a month starting out. So, it adds up to about $1,200 a year. And I don't know this number for sure, but let's say that every year your dividends grow by like 3%. And then the price of your shares grows by about 6%, which is about, the average, maybe a little bit lower. We're being conservative with this. So let's see over time in 26 years, what your portfolio might look like. And this also takes taxes into consideration. So in 26 years, you're going to be 50 years old. Now, just this first year, like we saw, you're making about $200. After this year, your portfolio might be almost $12,000. So if we keep going, we can see that over time, your annual dividend income is just going to keep growing. And similarly, we can see that your dividend yield is going to continue to grow. Now, if we go all the way to the bottom here, all 26 years, when you're 50 years old, just by investing $100 a month, your annual dividend income will be about $7,500 just from dividends. And the balance of your portfolio will be almost $200,000. Now, that might not seem very exciting at first. Might not seem very exciting, but that's because you're only investing $100 a month. Now, you're not going to be doing that forever. So in time, as you do this more naturally, you'll probably step up your, the amount you're contributing. And let's say you're feeling really frisky and you decide, after this, Ryan's right. I need to step it up. Well, maybe you decide, okay, I'm going to invest $200 a month now. So $50 a week. That's what, $2,400 a year. Let's see kind of what that might look like in the same time when you're 50. So by doing that, at the end of that 26 years, you'll have about $11,500 in dividend income, and your portfolio will be at just over $300,000 instead of that $197,000 or $192,000, whatever it was. Mm-hmm. So by investing
basically 200 bucks a month instead of 100, you'll have 100 grand more in 26 years based on this. Now, that still might not sound very exciting. Obviously, the rule of thumb is the more you invest, the higher your income's going to be. So let's say you're doing what I'm doing right now. I invest 100 bucks a week. So that comes out to, well, 100 bucks a week, 400. Yeah. So 4,800 bucks a year. It's probably more, but we'll just say that for this demonstration. At the end of that 26 years, it'll be almost $20,000, and you'll have over $500,000 saved in that. Okay. Now that's your portfolio not as it currently stands, but after these changes. Now, let's say you get rocking and rolling. You're like, you know what? This has been great, but Ford's just not doing it for me anymore. Berkshire Hathaway, I loved it, got a lot of money from it, but I think I can, I'm ready to put that into something else. Same thing with Tejon Ranch. So let's say you just completely commit to dividends. Well, let's take this other example over here. Maybe once you sell out of those, you invest in some other companies, and now your new dividend yield is 3.5% instead of 2%. So same starting principle, just for this demonstration, $10,000, 100 bucks a month, growing a little bit quicker, maybe 5% every year. Let's see what that looks like. So if we scroll down, after 26 years, $34,000.
Oh, wow.
So yeah, so that's what, almost twice as much as if you were to just keep the stocks you have or not keep the stocks you have, but make those few changes and keep some that are not in dividends. But as you go down the road, you'll make more tweaks. You'll find out as you learn more about this, what works for you, what doesn't work for you, stuff like that. And so in making those changes and in evolving as an investor, or paying more attention to this, you'll probably get to a number that's closer to this 3.5%. You might even hit 4%, which is actually not hard to do. My portfolio yields 4.5% right now. Just by investing $100 a month at a 4% dividend yield, you will be at almost $50,000 a year just in dividend income, and your portfolio will be at almost $400,000. So, which isn't a super, like a much bigger difference than investing 200 bucks a month with a 2% dividend yield. I think you had over $300,000, but the dividend income was like 4 times that just by having a higher dividend yield. So, and then, you can just keep messing with it and keep tweaking it. Maybe you bump that up to 200 bucks a month, 4% yield. My goodness, you're at almost $80,000 a year just in dividends and $600,000 in your portfolio. So there's so many ways you can skin the cat. It's really a numbers game. But, by showing these examples, it just kind of helps paint you a picture as to what things might look like if you made certain tweaks or certain changes to your portfolio. It kind of helps you plan out for the future and map things out a little bit better. So you can set this up the way that works for you, the way that you like it, just based on how much money you want to make someday. And one other side note to this is one thing that would be good to think about is, well, what am I really doing this for? What's my why with investing? What am I going to use this money for someday? Is this for vacation? Is this something that I want to retire and have paying me? What's my why here? So that's something that you'll have to think of too. And that will also help determine the stocks that you invest in and how you approach your portfolio. So for me, in my case, I like dividends and I like investing this way and going for, that dividend income, because someday I just want dividends to pay me money. I want to live off, the stocks that I own without having to sell them someday. And I know that's something I've explained to you before, but nonetheless, whatever your why is, it's important that you at least have some idea of what that is. Does that kind of make sense?
Totally.
And honestly, that's kind of all I had to show you for all this. I hope this kind of helps paint a picture and helps you understand kind of what changes might be good to make. And just also remember, this is not set in stone. So if you want to do it a little bit differently, or if you want to do it different, by all means, it's your portfolio. Do it the way that you like it, the way that you want it. I just tried to set it up. If it was me, what might I do if it was my portfolio?
Yeah, no, this is good. So in terms of when I put more money into my account, would I just buy more shares of the stocks I have then?
Mm-hmm.
When is the right time for that? Or does that just depend on?
That's a great question. That actually was something I was going to address next. So first, and I mean, I can help you with this off camera, obviously, or whatever, but first figure out exactly what you want to sell, what you want to get rid of, what you want to hold on to. These are just changes that I'm recommending.
Right.
If it was me, but you might think a little bit differently. So figure out what exactly you'd be okay selling out of, figure out what you would want to hold on to. First, figure that out, and then that would be the best place to start. And then from there, just feel free to sell out of those. And depending on how much cash you have, you might just want to start dumping it in some of these stocks that are going to be good to buy, or you might want to spread it out over time. So let's say, for example, you end up with about, $4,300, $4,400 to invest from selling out of these positions. Well, you may not want to put all $4,000 into the market at one time. You may want to do what's called dollar cost averaging, which is to slowly invest it over time. And that's going to help mitigate any sort of volatility that might happen in the market. It's going to allow you to kind of average in. So you have, your cost per share is kind of an average of what's been happening in the market over time. That is one way to approach it, or you can just dump it in as, all at once, just to get the ball rolling. It's totally your preference. Like I said, you're 24 years old. In the long run, it's really not going to make a huge difference how quickly you invest it right now or reinvest it right now. What will make the difference is just by investing consistently over time, which is what you're going to be doing. Does that kind of answer your question?
Yeah, totally.
Okay. Yeah, I'm glad you asked that. So yeah, figure out what you want to sell, and then also figure out what you want to buy, and I guess just go for it.
Okay, cool.
And I can help you with that if you want to come up with something specific or something concrete, and just see what I think. That's however you want to do it.
Okay.
There's a couple other things I wanted to show you. So some of these stocks here, you'll notice, are over $100 per share, which might be an issue when we're only investing $100 a month. So kind of begs the question, well, how am I going to buy into them if they're more expensive than what really I can afford every single month? So Charles Schwab has this thing. You've heard of buying fractional shares. That's something I've explained before. Charles Schwab has this thing called stock slices, which is essentially their version of being able to buy fractional shares. So you can go into Charles Schwab stock slices and look up Apple and say, I have $100. I'm going to spend all $100 on Apple, and you'll be able to buy like a fraction of a share. And so for those companies, that would be how in most cases, that would be how I would recommend going about buying these stocks. Some of these might not be available in stock slices, but just from looking at it, they should all be there. Actually, all of these bigger companies should be in there for sure. So that would be kind of how to go about buying it on a monthly basis, a weekly basis, however often you do it. The last thing I want to show you too. So we've gone through this entire portfolio, or this spreadsheet here pretty much that I've made, but you might not want to deal with this every month or however often. You might not want to keep track of your portfolio in this way. I do think it would be beneficial to, if you're going to be actively putting money in, it would be beneficial to have some sort of way to track like what you're buying and how much that's bringing in for you, some sort of visualizer for you. Now, if you don't want to use something like this, which has a bunch of stuff you might not care about, like PE ratios or earnings per share, or yield on cost, you might not need to know that information right now. If you are going to use any sort of portfolio tracker and you don't want to use this one, and keep in mind, you don't have to do any of this. But if you were going to, there's another really cool free one online called Track Your Dividends. Just trackyourdividends.com. I use that for the longest time, and it was actually really helpful for me to be able to paint a picture. And it more or less offers similar things. You can see how many shares you have, the annual income for those shares, see how much you're taking in for dividends. It'll show you your dividend yield. It can even show you your kind of some pie charts, kind of like on mine, by sector, and then over here by stock. So it does kind of similar things. And it's really helped me just keep track of my portfolio and give me a good idea of what I might want to buy or whatever. And one other thing you actually asked earlier is like, well, do I just buy these stocks then, or should I, like, what do I do? you can always add more stocks. You can always subtract other stocks. So if you go with something like this, and then in time, you're like, I want to invest into this. This sounds really cool. I might want to give this a shot. Yeah, go for it. Just feel free to just buy into it. It's your portfolio. You can do it however you want.
And
And
always
similarly,
reinvest dividends, correct?
what's that?
Always reinvest the dividends.
Always reinvest the dividends. Yeah. But another thing too. So, I mean, in your portfolio, you still have stocks that don't pay dividends, which is okay. You don't have to take my exact approach. Part of the fun of it is doing it your way and kind of building it the way that you like it. And so if you see another stock that's maybe more speculative, like a workhorse, or maybe you're like, I want to buy into like Shopify or Etsy seems really cool, or something, that you heard about that you might want to give a shot. Yeah, go for it. See what happens. Trial and error. That's really what it's all about.
Mm-hmm.
So, but at least by making a few of these other changes, you'll have a good balance of getting some cash flow and still getting stocks that appreciate pretty well.
Yeah.
So
cool.
Anyway, that's about all I got for you. Do you have any other questions for me?
No, I guess I'll just start going about the process of getting rid of the stocks that are in there that you mentioned to sell. And then once that happens, I'm just going to pretty much figure out which ones. And I think you could probably help me out with some of that stuff on how many shares, but it looks like it's already on here for the most part.
Yeah. And if you want access to this portfolio, I'll send it to you.
Yeah.
It's super easy. I mean, really all these yellow columns is really where that's where you put in information. Everything else pretty much auto populates.
Yeah.
If you want this, I'll send it to you. If you don't want it, that's fine too. And additionally, like I said, whatever you need help with making these changes or doing whatever, feel free to bug me about it. I love this stuff. So I'm happy to help however.
Perfect.
Yeah. So anyway,
I think I'm good. I mean, it's pretty straightforward. It's crazy. Just like, 20 minutes or so have we been on this thing?
Oh, we've been on it almost an hour.
Oh,
we've gone about 45 minutes, maybe a little bit less.
Well, that's my point is like, even just 45 minutes of really looking at this stuff is eye-opening when somebody who understands a little bit more just runs it all over with you. So like, I feel pretty, before, and I feel like I knew this stuff okay, but now I feel like I know it pretty well.
Yeah. And you like just naturally by spending more time with it, being more active with it, you'll naturally evolve and you'll learn even more.
Yeah.
And you never know, by getting your feet wet and being a little more active, you might come to like it a little more. That's kind of how it started working for me.
Yeah.
The more that I saw things growing, the more progress I kind of started seeing with it. It just got me a little bit more excited. And then you just get more curious and then you learn more. And then, it's kind of snowballs from there. So
yeah. Cool.
Anyway, I'm going to stop sharing my screen. And yeah, well, I guess we can wrap it up here. I need to hop off. I have a 5 o'clock. It's 4:51 for those of you who are watching this video, 4:51 p.m. I have a 5 o'clock with Warren Buffett. He's just had a couple questions. I'm going to do this kind of the same thing with him. So.
Right. Yeah. You and him, you like to play, what is it, cricket together?
No, badminton.
Gotcha.
Yeah.
That's right.
But we play with the cricket. Wait, which one's cricket? That's the baseball one, right?
So it's like the Indian sport.
We play with cricket paddles. I don't think you call them bats. You can call them paddles. That's what we call them. Yeah.
Yeah.
Warren calls them spankers. Spankers.
Yeah. That's very, very like him too.
You don't want to know why.
You're so funny.
All right. Well, thank you again. Thank you again for doing this with me. I'm pumped that we got to do this. And
yeah, I'm too.
But yeah, bug me, whatever help you need. I'm here to help.
Perfect. I'll probably if you could just like send over that stuff, that'd be super helpful. But yeah, I mean, for the most part, I'll get on this as soon as I can.
No worries. I'll send over the spreadsheet. I'll just share a link with you to do it.
Yeah. And
I'll also take a screenshot of that document I had that showed the sells and the buys and stuff like that.
Cool.
So, all right, cool. Well, I will talk to you sometime soon. I'll send that stuff over to you right now.
All right. Perfect. Thank you.
Right. Yeah. Thank you. Later.